maybe this is where I ask both the two of you about the length of commitments nowadays. I thought we'll discuss it then, but probably this is the right time. Regulatory environment is uncertain. Signing and closing, you have no visibility. So tell me about the risk mitigation or risk sharing mechanisms that you have in financing papers to address some of this lengthened period of commitments.
For sure, the setup, but you need to establish to commit to financing via the bank market before you can go to the bond market. For sure, the commitment periods are getting longer. So it used to be unheard of to do beyond a year and a half of commitment period. Now, a year and a half, 2 years is becoming common, just to address the regulatory risk area. And like the bigger the deal, the more regulatory risk, as Kevin was saying, for sure. So I think for us, it's back to the maximizing financial flexibility is really a question of how much term loan versus permanent financing is necessary. And that can come out of a couple of different drivers. Certainly the company size sector, the ability to delever are huge drivers of that, of how much term loan we should put in there. Pushing leverage within a certain ratings category, being able to delever, all very important. But what we find interesting is more or less on what I would call the sub $5 billion events, where do you really need a bridge? The issue fundamentally with the bridge is that it forces you to the bond market, either now or later, and I'm sure Moshe can, we'll talk about that. But the financial flexibility part is really, should that $5 billion bridge be a $5 billion term loan? You can still take it out in the capital markets. There's no restriction on that. But with the volatility in the bond market, does it make sense to have at least a backup plan in case the markets aren't there for you, where you can draw on the term loan temporarily and then go back to the bond market later? Maybe, right? It all depends on market conditions in both markets. But we are starting to have that dialogue more with companies about the sub $5 billion deal, forgoing the bridge, putting in a term loan backstop, still having a takeout, but having more flexibility when that can occur.
Now, I'll come to you, Moshe. You talked about term loan versus bridges, and there's this optimal size. Again, we talk about this lengthened period between signing and closing, and you don't want to bridge their outstanding. You want to go and do a capital markets transaction. How do you decide when to go to the markets?
That's a great question, Atish. I think what I've generally seen, so if you have a bridge, and to Seth's point, if you end up drawing down on that bridge, the cost of that's going to be very punitive. So what you want to avoid is being in a position that you're funding real close to the actual close date, because if the market's not there, you're drawing on it. So what we typically see is clients give about 2 to 3 months of pre-funding cushion in advance of the bridge, and basically layer in their financing then. And to your risk question, one of the things, the problem with pre-funding is that if the acquisition doesn't close, you're sitting on a bunch of debt you don't want. So the crafty minds on Wall Street designed a feature to address that, where we essentially exported closing risk to the buy side. And this pertains to a feature we like to call the special mandatory redemption, or SMR. And what this allows you to do is not allows, it's mandatorily redeemable at 101 in the event that the acquisition doesn't close. So all of a sudden, the buy side, you've exported closing risk to the buy side, which has made them that much more attuned and focused on what's going on in the regulatory backdrop. Your other main risks are you have rate risk, and if it's a cross-border transaction, you have FX risk. And I look at FX in M&A context as leverage risk, because if you're buying a euro asset and you're not a euro functional company and you don't hedge and the euro rips up 10%, your leverage has gone up at least 10%, and that might push you over the line from the rating agencies. So we look to hedge that, given the volatility and extended commitment periods. And the way we do that is have it contingent to the close of the deal. We call it deal contingent hedging. It's become increasingly popular for all the reasons that these guys have discussed. But again, another risk mitigating tool.